All right, folks, welcome back. This is our midweek and weekend commentary. As I stated, I would not be doing a video after today to celebrate the Thanksgiving holiday, spend time with my family and friends, and I suggest you do the same thing. Leave the markets alone. You do not need to worry about what the market's going to be doing the next couple days. Rest and enjoy your weekend, and we'll get back into the swing of things on Monday. All right, so here's the dollar index weekly chart. This is the next premium array that I believe that could be a upside draw on liquidity. It's the remaining portion of this fair value gap and buy side liquidity there. Okay, so we're digging a little bit deeper inside this breaker. Notice that the range of this down close candle here still encapsulates this fair value gap. So even though it's really up in the upper portion of that down close candle, it still is a very large bearish breaker, and it's a weekly chart. So if the dollar continues, and we're not trying to pick the top, as I mentioned, we avoid doing that. And by doing so, it allows you to have the confidence, or maybe I shouldn't say confidence yet, because most of you are developing confidence. It allows you to have the protocols in place to lean on, so that way by default and as a result, you develop confidence. All right, here's the daily chart of the dollar index. As you can see, we're pressing up into that area. It may not get there, but I believe until it proves otherwise, it's going to reach there. So it's, again, submitting to the idea that higher time frame order flow is in control. So we stick with that narrative. Two down close candles. Notice that? All this was an opportunity for it to start another leg higher. Down close candles do not end an uptrend. It does not end bullish institutional order flow. Okay, it provides you a way to anticipate the next leg higher, and vice versa when it's bearish. Hourly chart on the dollar index. Again, fair value gap in here, optimal trade entry as we mentioned before. Just reaching up in even highs here. So it looks like we may want to spike up into that, maybe going over the Thanksgiving holiday. The market gets very, very thin, very, very thin. And on Thursday and Friday, we'll likely see spotty moves and just real illiquid times. Even during the normal heaviest volume, there may be, pockets of illiquidity, and you'll see these weird spikes. And as I mentioned a number of years ago, I was actually trading through FXCM, and I got hurt because it had some wild spike on Thanksgiving, and it just completely smashed the trade I was in, but the stop wasn't honored by them. US dollar index, 15-minute time frame. All right, so we had a buy side and balance, sell side inefficiency in the form of a bullish fair value gap. Down close candle, that's your bullish order block. Extend that out in time. Drops down into that and the order block. Optimal trade entry, low to high, down. Rallies, small little volume imbalance. See that? Drop down into that, picks up more orders. Rallies, consolidates, drops back down into the order block here. Perfect. Look at your low on this candle here. It matches to the pipette on this up close candle here. Perfect delivery, perfect institutional order flow. Rallies, small little fair value gap in here. Fills it with the bodies. Yes, we have errant price action where the wick or tail drops down below it. It's just coming back down inside the order block. Picks up more orders there and rallies. Drops back down again into the order block and then just consolidates into relative equal highs. So it's building what? Retail resistance. What are they going to be doing? They're going to be looking for a high to form. They're going to be looking for a sell-off because they think this is a wall of price action that will not be breached. So their books tell them to do what? Put a buy stop above that and go short. So it's allowing, the algorithm is allowing liquidity to start pooling. So this is engineering of liquidity. And if it wasn't so much a holiday going into tomorrow and Friday's low volume expected to, I would have a lot of interest in seeing that level ran out. But because it's a holiday, just look at it over the weekend after the fact. You don't need to be getting in here trying to do anything with this. All right, Eurodollar daily chart. And as luck would have it, here we are down in the area that I mentioned that IPTA would draw price down into. This is that imbalance. And we mentioned yesterday that I would like this to see this level traded to. That'd be a victory enough for this week. I also told you that we have to treat this week like a non-farm payroll week. That means all of your trades must be entered by Wednesday, 7 o'clock in the morning, New York time. No new entries should be or would be considered after that. Now, open positions can be managed obviously beyond that, but for the sake of new entries or new setups, you can't do it. Okay, you got to have that rule in place, and if you want to skirt that, you do it at your own peril. But train yourself in your demo account to do these types of things. That way, when you ever consider live funds at your own discretion and timing, you'll have this as a routine to avoid very illiquid periods of time where the market can move adversely very quickly against you. And that's what this condition is for this week now, for Thursday and Friday. But we almost made it down to our my specific level, 111.68 and 1 pipette. So, do we get that spike above the relative equal highs that are forming on the dollar index intraday charts? If that occurs and it gets a little bit more overzealous on the upside, then I think my level here may be traded to before the close of the week. Does it need to do it? No, because ultimately this was enough for me for the week. And moving on into the hourly chart, you can see here at 7 o'clock in the morning, New York time, it trades to it. So here's 7 o'clock. So it meets our time window in terms of reaching for that level for this particular trading week. It was not an ambiguous level. We weren't wishy-washy about what direction it was. It was exactly out of the book of ICT. Okay, so I want to take your attention to this area right in here, which sets up this framework for the 24th or Wednesday's trading. Notice we had the fair value gap here in the form of a buy side imbalance, sell side inefficiency, followed by a sell side imbalance, buy side inefficiency. So we have what? A balanced price range. Okay, so if the market trades back up into that, you can anticipate the market hitting that and thinking, well, it's really no need to go up there because we've already balanced this out here. But if it ever does go through it, the premium high should act like a iron wall. Okay, it shouldn't be able to go through that. But let's take a lower time frame look at this on the 15-minute time frame. Again, balanced price range, extend it out in time, hits it, bang, slams right into that candle's high. Then we have the buy side liquidity pool, relative equal highs. So we have the opening price at midnight, New York time. Extend that out as your opening price. We anticipated what? Price drawing down into this area here. And more specifically for the week, this level here. I mentioned that last night. Ideally, we want to be selling above the opening price at midnight. That's what I teach in the day trading. That's what I teach in a lot of the price action models. And we anticipate that in the form of a Judas swing, a rally above the opening price. It does so in London. Here's London set to daylight savings times, but you don't need to worry about that. It's going to still be in the same window, whether you reflect the daylight savings time in your chart or not. And this chart I am showing with daylight savings time, but for the sake of completeness, I do not respect the daylight savings times when it comes to the kill zones. I just use the extended kill zones, which I've taught extensively in this mentorship. So don't lose your mind over it, okay? Don't get confused and think, oh, I need to know this and I need to know that, and I'm confused. What do I do? Just stick to the New York time. There's no worry about doing that. To avoid that, I have a adjusted kill zone where I just use the same times, but I extend an hour on it. So it just gives me a little bit wider range, and I don't care. I'm going to find the setup. I'm looking for the PD array more specifically because I know sometimes the algorithm can be a little bit early because there's manual intervention. Okay, and it's usually what happens. The algorithm is based on time and price, but once in a while, if there's something that is coming up in terms of a big report or whatever ahead of New York, they'll probably gun a specific area, ahead of 6:45 a.m. So around 6:30 in the morning, you might get some wild spike that creates the actual low or high that you would have rather expected to see form in the New York session after 7 o'clock in the morning. But, that's just for your notes here. But we have a rally up in, bumping the buy-side liquidity here in the balanced price range. Perfect delivery. Can't ask for anything better than that. Then it breaks down. We have displacement below the low here with this big candle. The next candle closes here. So what do we have here? A fair value gap inside of a bearish breaker. Send that out in time. Boom. This pattern here, folks, this one right here, fair value gap with a breaker with institutional order flow that's bearish and a target below. Like, that is one of my favorite patterns. It's so consistent. It's so easy to see. It literally jumps off the chart. You can see it obviously in hindsight because I'm showing it to you. But if you study price and you're looking at it, when you see these things forming, it's so obvious what the algorithm's going to do. Like, it's so painfully obvious what it's doing. And then you have a delivery like this. Now, it's not a lot of pips. Don't get me wrong. I'm not trying to make a big deal out of 20 pips or so. But that right there, that's enough. That's the framework I mentioned the other day when I was discussing the using funded accounts and just reaching back at the basics of 25 pips per week. Well, there you go. You have this high. Here's 10, 20, and then 30. You can get that on both sides. 25 pips on the spreads, in and out. You can get that. And we have a bearish order block here. Sell sign of balance, buy sign of efficiency. Trades and falls short of the order block and then hits it here. But now look what time of day it is. Do you anticipate a big sell-off? No. Why? Why wouldn't you expect a big sell-off there? Well, number one, time, because we have rules. We're treating this week as a non-farm payroll week, so we have to stop entering new trades at 7 o'clock in the morning on Wednesday. While it does drift lower, it doesn't have a lot of energy. And then look what happens. It goes into this consolidation. This is why I teach you the time elements and the weekly profiles and the algorithmic principles that will lead to you getting caught in something you would rather not be a part of. You don't want to be selling short down here because you already dipped into an objective. Like, we had this objective down here, this blue shaded imbalance for weeks now. So it dipped into what we were reaching for. Why would you want to go short just now as you got into it? This is a bear flag. And while it does pretty much deliver to that, we're not trying to get in there and trade that. It's met an objective, a higher time frame discount array. So we do not look to take new trades, and we certainly don't want to do it with the time element I've been teaching you. And then you see the signatures in price that will materialize. Crap. It's consolidation, muddy price action. This is what I mean when it gets muddy. This is it right here. It's not doing anything. It's just trading listlessly. It's marking time. It's not doing anything because the algorithm has gone idle. That means it picks a random range that is not all that important, and you're seeing the low here and the high in here, and it's just banging around in that range. How does it determine that range? I don't know. So that's the reason why I have these time windows here after 7 o'clock on a Wednesday. I don't want to trade, and I don't want to put a new trade in because it does things I don't know how to decipher or why it's doing it. Remember, I don't know everything about the algorithm in the sense that I can communicate it through a chart with you. And there's certain things I just didn't understand when I was exposed to it. So you don't know everything, and I don't know everything. But you don't need to know everything to be consistently successful in reading price. If you have these rules, as I'm teaching them, they will serve you well. If you do not follow them, you can't reasonably expect to be successful. You can't, because you're trying to reinvent it. I've already done the hard work and paid the price and losing money, real money, trying to figure out these areas. So because they were painful, because they caused me real monetary loss, I use them to say, okay, this is an area where I don't want to tread in because I know it's a landmine field. That's after 7 o'clock on Wednesday, on a non-farm payroll week, and now obviously on Thanksgiving, because we're using that same mentality. For those individuals that want to trade this week, which I don't want to inspire you to want to do that, but obviously you can see the algorithm delivered what we were looking for. It still has the same signatures that you would expect when we're bearish, and it delivers beautifully. And then it gets ugly after that time window I teach. Think about it. How many times have you seen a New York session that just trades beautifully, has perfect market symmetry, beautiful runs into liquidity, and just real nice precision? But then when I tell you a specific time window on a specific day, don't go beyond that with new entries. Why? Because it's not going to be favorable for you, because the market can be messy, sloppy, or muddy. There it is right there. That's what it looks like. You want to screen capture this and say, this is the reason why. This is the expectation of price post 7 o'clock in the morning New York time on non-farm payroll weeks and holiday weeks, where you have a holiday towards like the end of the week like we have every year in Thanksgiving. All right, pound dollar, daily chart. Again, we were covering this market maker sell model here, and we dug into that a little bit deeper. So we'll take a look at that on the hourly chart, and just beautiful. Look at that. Man, that's just like right out of an old YouTube video, isn't it? So the original consolidation, we know there's sell side below that. Shallow little run. Now, as I was mentioning, I forgot which market I was talking about. It escapes me. I hate when this happens. But I was recently talking about how a market's bullish, and we were looking for a market maker buy model. And if the underlying market is bullish, and I think if I'm not mistaken, it might be NASDAQ 100. Don't quote me on that, but I think that's the market I'm thinking of. But I was discussing the market maker buy model and how sometimes when the market is underlyingly bearish on a higher time frame, but we're trading with the framework of a market maker buy model, that means we expect the market to go up above old relative equal highs or original consolidation, but that shallow run is probably all there is, and we can get short on that idea because the higher time frame is bearish. But when it's bullish long term, the market maker buy models can go way beyond the original consolidation for that buy sell liquidity and just keep on going higher. Well, the same thing is in reverse here. Since we have a dollar that's bullish and reaching for potentially higher weekly and daily premium arrays for dollar index, that's going to pull foreign currency down. And we have a market maker sell model that's being shown here, and we've been discussing it with this particular pair here. But the sell side here, notice what happens. It goes below it a little bit and then comes right back in, bearish order block 1-2 times, and then sells off for a deeper run for the liquidity. Why does it want to go one more time after the shallow run? The same thing I disclosed when we were looking at the NASDAQ with the market maker buy model. This market maker sell model is inside of a bearish market structure and higher time frame order flow relative to the bullishness that's in the dollar index. So when you see these little shallow drops for the liquidity, original consolidation, accumulation, reaccumulation, smart money reversal, lower sell, distribution, redistribution, sells off. And we get this little tiny run below here. In an underlyingly bearish market, anticipate another return back to some premium array. What's the dealing range? This high, this low. We're above it for a premium market. Bearish order block, sell it here. If you missed it, sell it here. And then rolls over, digs in deeper below the sell side here. And a deeper pass through on this old low because of a market maker sell model existing in a higher time frame bearish market. So you get better passes below old lows on the market maker sell models when we're in bearish markets. If this was a bullish market, this would probably be all there was to it, and then it would start to move higher, and this would be a market maker buy model. So it's all an overlapping and understand what the current narrative is against the higher time frame order flow. What I just said sounds like a whole lot of mumbo jumbo, but I promise if you've been keeping notes and you're following along with other supportive lessons and the things I teach you in the core content, those things will start to mean something to you, especially as we go through more examples and talking about it before it happens. All right, 15-minute time frame on the pound dollar. Here's that hourly bearish order block. That's what this is being anchored to, and trades right up into that. Then we have displacement. See that? How do I know it's displacement? We take out a short-term low, and we have a gap. That's your signature. How do I know when a market has a reason to anticipate a setup with a shift in market structure? Well, it's got to take out a short-term low, obviously, and we have a PD array in the form of premium fair value gap. Displacement is a quick sudden move below a short-term low, and it leaves a small little gap. That's the interbank signature for that particular fractal. If it trades back up into that, that's where they want to go short. It breaks down, rebalances up into the order block again, trades right back into the range here, sells off. One more time, passes up into all this dealing range low to high. We're in a premium again, sells off. Another level of displacement. Why? Because we took out a short-term low. We have an imbalance. Market trades up into that. That's a short. Why? Because we have yet to take out that short-term low here. And we're anticipating a deeper run below that hourly. Let me go back up to the hourly chart. We're in here. We're anticipating this low to get past deeper and go lower, much lower than this short-term dig below that low there. So a little bit of a move below this low. We're here. We're anticipating it to drive aggressively more deeper below this low, and more specifically this one, because we're in a market maker sell model in a bearish market. So back to the 15-minute time frame, imbalance, we can anticipate a run below this low, but not just a subtle little dip below there. Why? Because this was a subtle little shallow run below the old low on the hourly chart that frames the original consolidation on the market maker sell model for pound dollar 60-minute chart. So we're anticipating this to be ran out here after it rebalances, and then aggressive sell-off. What else do you see here in this sell sign imbalance buy sign inefficiency? High, low, high. Down close candle, that's your bearish breaker. We're digging up into that mean threshold, bam. Rebalances, perfect. Sell off. Now, even though it's sloppy and muddy because it's post 7 a.m., okay, how would you use this information? You can't enter new trades at 7 o'clock in the morning because of the weekly protocol. We're treating it like non-farm payroll week. So if you sold short ahead of all of the decline in here, like if you're short here and you're managing something in here, you can take partials when we start breaking down in here and going below that low, but we can't enter new trades. So you're watching an opening existing trade, hypothetically, and you're anticipating it to react here. So that's trade management, not new entry. All right, and if you take a look at the swing trading ideas I use to get targeting, you have this high down to that low with your fib. You have 1/2 of a standard deviation of the range low to range high. You have that here, and just beautiful. It just goes below just a little bit, but nonetheless, that's where you would look to try to take profits on this day. All right, this brings us to our homework assignment. I gave you the NASDAQ 100 hourly chart, and I mentioned how you should go in, frame out this high to this low, and what constitutes this as a nice range to work within and a reversal pattern. We're not calling the top, we're not calling the reversal long term, but we're studying it, okay? And I want you to see what's here. Now, I posted a chart in the charter members area of the forum, and it's found in the new thread I created, and it's something to the effect of index, intraday, I can't recall. Forgive me. I don't know what the title of the thread was, but it's a recent thread I created, and I posted a chart which you'll see in a second. But I want the charter members to go in and post their observations after the market has traded. Some of you are trying to predict things, okay, and that's not what I'm asking you to do. I want you to post your observations in the indices, okay, and you don't need to do both. Well, not both, but you don't need to do all three, NASDAQ, Dow, and SPOOs or S&P. Just pick one, okay? Whatever one you like technically that really resonates with you when you're studying it in hindsight, and then dress it up and share it with the community, how you're seeing, what means most to you in technicals that has transpired for that particular day. And what you'll find is there's a not not a difference in a bad sense, but there is a difference in the sense that's unique. Everybody will have a personal interpretation of what they see using the same tools, and how much you can glean from another person's interpretation as a student. It's not meant to see you're better than that one or not as good as this one. You're just comparing notes. You're not being tested. I'm not asking you to prove you're going to predict today's move or next, Friday's move. I'm not asking you to do that. What I'm asking you to do is record your observations. Okay. All right. So here is the daily chart. Just for context, we ran up in here. We pressed above this short-term high. So we had a high. It broke down. I mentioned that we're not trying to pick a top. So, but what has happened is short sellers have came in, and there's a lot of liquidity here pulling buy stops. So the market runs through that as we were expecting. We were anticipating this run higher. We did not call crash. We did not call a top. We were just warning that the trend is still bullish, but as we were going higher, I mentioned in the commentaries, go back and listen to it. You'll swear it wasn't there the first time you heard it. I said that the averages are not confirming this run higher on NASDAQ. So I'll show you what that means and what I was saying there. All right, so here's the hourly chart. This is a naked chart in here. And we had a parabolic run here. Real aggressive little run while the market was diverging across the other averages, the Dow and the S&P. They were not confirming this run higher. We broke down institutional order flow entry drill here. We break down again, another institutional order flow entry drill here, and sell off. Now, I believe this is all I was asking you to do here, but I'm going to give you all this in here as extra, just because I feel up generous. No extra charge. But here is what we're looking at. Watch closely. We are seeing the NASDAQ 100 pressing higher. The Dow is not going higher. And the S&P was posting a higher high, but not so overzealous like we had in the NASDAQ. Okay. So what does that mean? We have a index divergence in the form of SMT, smart money technique. And when this happens and we're at all-time highs, it's traded above an old high. When I say this, don't just listen to me and think, or whatever. I hear you, ICT. Write it down, okay? We have stretched out a lot. We're at all-time highs, and we had a short-term high that we just traded above. So what are they creating here? An opportunity for buyers to come in at a high price. They're forcing that. And that's why I was saying that we're likely to continue. We're going to take that high out. I didn't know how far we're going to go because I don't know. We're in all-time highs. This could have went all the way up to 20,000. I don't know. So, but we have buy side above here in this old high that it's going to reach into. Now watch what happens. As this is occurring, the Dow is failing to make a higher high. That is a warning sign. I'm not trying to call the top. It just means that's a warning sign that we are really digging in here. And traders that were looking to sell from longs and longs from here, they really have a nice pool of liquidity above this area that want to buy because they're trying to pick a top and they're selling short. This big drop down in here I mentioned before, that doesn't mean we've topped. All this does is provide an opportunity or a speed bump for the market to go higher and run out this buy side here. That has been engineered with these two down close candles that were nice sell-offs. Then we routed above the short-term high, and we now are seeing buyers down here selling up here above this old high where new buy stops are forming because the retail traders or people that are trying to pick the top sold short and they want to put a stop loss above that short-term high. So that liquidity for buying on their shorts to cover, those buyers are being paired with smart money that bought down here and here and here and here. So they're distributing their longs above this high. That is how I teach you to take profits. If you're long, take them off above short-term highs. That's what smart money does. That's what they do. okay? Because they pair up the liquidity that exists or will be engineered in this sense, as we're seeing here. And it provides the perfect opportunity to put buyers on the other side of your sell orders that lets you get out of your long position. All right, so here's the 15-minute time frame. This is pretty much the chart with more data that I posted in the forum thread for charter members. I mentioned last week, I said that if the market could potentially, in one of the commentaries, and it was this particular day, I said, it looks like it traded back up in there and it could possibly sell off in here, in this range here. So this fair value gap I took your attention to. But we opened up here on the new week. So by opening up here, we have a gap opening. We trade down and fill the gap, and we find support at the premium high of that old gap there. So a level I was drawing your attention to that could potentially see it selling off, we had a higher gap opening on the new week. So that nixes the idea of going short here because we're already above it. So we have an opening gap, it comes down, fills the gap, hits the top of the fair value gap here. This is premium high of the fair value gap, but it acts like a discount PD array because we're above it here. And we're trading down into it. Remember, fair value gaps act like what you would expect support and resistance to do. We see it trading here, fills the gap, and trades down to the premium high, then rallies. And then we go into consolidation. So all this in here is distortion by time, and then we have the parabolic run higher. And I asked the charter members, why is this level here salient? What is that level and why would it be salient? We'll come back to that in a second. The gap opening here, once we trade through it, when we come back up to not only the old fair value gap, notice the body of the candle, basically it's consequent encroachment. You see that? Midpoint of that gap. But we spike up with errant price action into that weekly gap opening again there. Two premium arrays there, but the logic is this is where order flow should be seen as bearish. As long as we're below, if it trades up into it, it should be bearish. But with the new week, we open higher. So it wasn't a matter that we traded down into it or traded from a new opening up into it to sell off. We don't know what some of these gaps are going to do. We have no idea what it's going to do. I don't know, you don't know, you're never going to know. But we gapped open higher here, and we dropped down, filled the gap, consolidation, spike, parabolic price action, and then give up the ghost there. Back to the gap opening, and the body's showing the bulk of the volume inside the consequent encroachment of that fair value gap. And what's going on again? Short-term high, we rally above it. Short sellers that want to sell short here, they'd see this drop down here. Yeah, get short. It's a bear flag. Buy stops in place to protect themselves. Great. Those buy stops are going to be used for smart money to go short at these premium arrays right here. The gap opening and the fair value gap. Where's liquidity is going to aim for? This one down here. And all of this price action in here and down in here, we'll show you some levels for that now. Why is this level salient? We don't know how to call the ultimate top in the marketplace, okay? There's a few markets I got real close with picking the highs. One of them was Ripple. I think it went to 310. I think it was 310. Don't quote me on it, but I did it when I was on Twitter, and ended up creating the actual high right on it, and then it crashed. I did a few times with the bond market. I did a few times with the S&P on like hourly and 4-hour charts. But for daily charts, like I've never really had that much, precision when it comes to that. But this is just to illustrate how I've been telling you all to anticipate new runs for buy-side liquidity and just keep trusting it until the market proves to you otherwise. Well, it proved it here. Okay, something definitely came in behind the scenes based on that divergence I warned about, saying that the major averages were not supporting this higher run on NASDAQ. The three averages, which is the NASDAQ, the Dow, and the S&P 500, as long as they're agreeing and going higher, each showing that higher high, the market internals are supporting continuation on the upside. It doesn't mean you won't have a correction lower. It just means you're likely to see sustained higher prices. Okay. Now, this is a problem in the short term, because I mentioned if we lose this and we go down, we're going to get back to those old highs on the daily chart. But I don't think that's good. If it goes down there, it'll probably go through them. Go back and listen to the commentaries. Every time I mentioned the NASDAQ 100, it's in the video. You'll swear it wasn't there, but it's there. So we went down to those old highs, and then it went through them. Notice that? That's what I told you what would happen if we went back to those highs. Whereas retail would see that as, oh, we're trading back down here to an old high. Let's be a buyer there. That's what they gave them right here. That was that baited mousetrap. And they gave them that little bit of a rally. They showed a high being broken. Okay, this is a breakout. Wrong. Smashed. Then institutional order flow entry drill again here. And then breaks down one more time. Let's take a look at this low to this high. Now, why are you picking that, Michael? Why are you doing that? Well, because we're seeing the market drop down to that low, and then it rallies again. And this is a little too muddy in here. This drop down starts all this run from here to here. Okay, that run is anchored right there. After coming back to this imbalance, this is the key low. And what was the high prior to that? Right there. So you take your fib, anchor it from there to here, and you want to see how many standard deviations it could potentially reach up into. It does 2 standard deviations, and that's what you get. You get real close to the bodies there. Now, admittedly, I did not anticipate this particular level, but I'm looking at this to see if I'm getting symmetry in the marketplace, and it does so here. So now what I can do is I can take this high down to that low and project targets. Because now I have a level that's showing me that this market's reacting on fib now really close to a level that can be discerned with swing trading ideas I teach in the mentorship core content. By taking that high down to that low, this was that level I showed you for homework. This is why it went there. Okay? The high down to that low. If this low is broken, which it is here, goes up to a premium array to sell off once more, bang, hits it. Look at the bodies, respecting that level. Yes, we have errant price action that goes down with a little tail there, but the bulk of the volume is really close to that level. Then we have institutional order flow entry drill here. Where does it sell off to? Same range, low to high. There's your level. Extend that out in time. Bam. And then we have a retracement that goes a little bit higher. And now we're just banging around in this range from this high and that low. This may not be the actual high. It may go higher. I don't know if that's going to happen right now. It needs to do some amazing accumulation and running higher, though, to do it. Because this is, in my opinion, technically problematic. Because we have a major daily chart diverging with all 3 averages, the Dow, the NASDAQ, and the S&P 500. And the technicals here are really indicating heavy distribution. Heavy distribution. So when we see premium arrays like this, and it sells off hard like that, and it goes back to an institutional order flow entry drill here, you anticipate what? Selling. The retail crowd's going to look at that old high on the daily chart, which is what that red line is. They want to wait for it to get there and sell short. Because some of you are probably thinking, why didn't you go up in here and eat into that a little bit more? Because you want to see that gap remain. Breakaway gap, measuring gap. Another gap that doesn't fill in, and that's what you want. You want to see these gaps stay open. When they stay open, what it's signifying to you is there's heavy distribution going on. The algorithm is communicating, okay? It's communicating that traders that are quote-unquote smart money, they're the institutional traders that are looking for things that would otherwise tip them off that this market's wanting to go lower. When you see these areas where retail would expect to sell up here, guess what? Support broken turns resistance. They're expecting that idea there. You are being trained to anticipate that staying open, and this just simply being institutional order flow entry drill. So we don't want to see it trade up there. Ideally, it should never return back to that level because that's what retail wants. Why do they want to give that to them? They're already giving you the indications this thing want to go lower. So why would they just give it to them on a silver platter there and retail ride along on the coattails of it? No. So the way they deny it is institutional order flow here, pumps it right into that, and leaves those individuals that thought they were smart, maybe they have sell orders up there, never gets filled. And it just breaks lower. Down to a level here, 1.5 standard deviations of the range from this low to that high. And just such a beautiful run down into that. So that was your homework review. I hope you get into this a little bit more, study this fractal. There's a little bit more things in here that you can mine for yourself in terms of annotations and observations. I'm not giving you a homework assignment because it is the holiday. I want you all to relax. And after this video tonight, unplug, folks. Don't worry about Thursday. Don't worry about Friday. Don't worry about anything on Saturday and Sunday. Just relax. Let your mind rest. Use this time to just decompress. Take a look at what we've been doing, on Monday. Go back into the swing of things. We've been really blessed with a lot of recent precision again. We like the atmosphere when it's like this. But eventually we'll go into another period, which comes in January. Unfortunately, you ain't going to like that again. But there's a few weeks in January where the market gets a little squirrely. And that's the reason why the second week of February, that's when I personally resume looking for setups. But I'm obligated, obviously, as a mentor, that I'll communicate what I think's in the charts and all that business. But just know that we are entering that period of time where there's weeks throughout the holidays and into January. I'm watching to see what the new year sentiment is. Sometimes it's clear and tells you what the next 6 to 12 months may be offering in terms of higher time frame trends or reversals. Other times it isn't that clear to determine or decipher, and I need all the way up to February to give me a framework to be confident about what I want to engage in. And again, I'm obviously not going to be without words. I'm going to say something. It may not be as nice as it's been here in the last couple of weeks, but it is going to be more learning because I have a lot of lessons I got to get through, and we'll have some more of that next week. Until I talk to you then, please enjoy your Thanksgiving holiday if you are those in the States that celebrate it. If not, just enjoy the long weekend, and I'll catch up with you on Monday. Be safe.